When a nation's financial reserves start draining rapidly, the immediate instinct is to brace for a severe economic impact. This chart traces India's foreign exchange reserves over the last 12 months, climbing to a historic peak of $716 billion. Then the trend broke. In a single week, over $11 billion vanished, the sharpest decline in over a year. For civil service aspirants using Saaflya AI UPSC to study economic security, this contraction is a critical, real-time case study in monetary policy. For those remembering the 1991 balance of payments crisis, this rapid depletion triggers a visceral fear of a national default. However, the current reality looks very different. Despite the drop, the rupee has held its ground, avoiding the collapse seen in previous decades. The Reserve Bank initiated this drawdown as a calculated execution of its macroeconomic defense protocol.
To understand the resilience of the Indian economy, we have to look past the headline numbers and deconstruct the 4 active market vectors currently draining the reserve. The Reserve Bank of India manages this defense protocol, acting as the primary custodian of the nation's financial stability. Vector 1 is active currency defense. Rising geopolitical tensions drive up crude oil prices, placing massive downward pressure on the Indian rupee. Without intervention, the rupee was at high risk of crossing the 95 or even 100 mark against the US dollar. This ledger shows the mechanics of the defense. The RBI sells its stored US dollars into the open market, absorbing excess rupee supply to hold the exchange rate firm. Vector 2 is the currency valuation effect. This is a passive mathematical reduction rather than an intentional market trade. India's $563 billion in foreign currency assets, or FCA, is not held entirely in stacks of physical U.S. currency. To generate yield, the RBI invests these assets in sovereign debt, primarily U.S. government treasury bonds. A significant portion of the FCA is also held in euro, British pound, and Japanese yen denominations. Because India reports its total reserves in US dollars, when the dollar index strengthens globally, other currencies automatically depreciate against it. Consequently, the total paper value of the reserves shrinks because the non-USD portion of the portfolio is now worth fewer dollars on paper. Billions can vanish from the official tally without the central bank ever executing a trade, purely due to the shift in global valuations. Beyond central bank actions, we must look at the behavior of international investors through Vector 3, foreign portfolio investment outflows. Prior to recent shocks, foreign capital had been heavily concentrated within India's domestic stock markets. When global instability increases across the world, these investors move to minimize risk by liquidating their Indian equity holdings. To repatriate their funds, these investors must convert their rupees back into US dollars before the capital can exit the country. To prevent this sudden dollar demand from crashing the rupee, the RBI injects dollars into the market to facilitate these exits smoothly.
Vector 4 involves inelastic import pressures. A nation cannot stop purchasing essential commodities, even when prices spike during a crisis. The sheer volume of the global physical commodities trade dictates these massive, unavoidable dollar payments to keep the nation running. When global prices for crude oil and gold rise, India must spend more dollars to secure the exact same physical volume of goods. Between fleeing investors and rising oil costs, the reserve acts as a shock absorber, taking the structural damage so the domestic economy remains stable. We also need to examine how the remaining $716 billion is structured to survive a fractured geopolitical landscape. This chart breaks down the current composition: $563 billion in foreign currency, $130 billion in gold, and small slivers for IMF positions. Gold used to account for only 6 to 8% of the total reserve. Today, that allocation has surged to 18%. This shift follows the weaponization of the US dollar and the risk of sanctions freezing sovereign assets, as seen in the recent case of Russia. Physical gold carries no counterparty risk and cannot be deactivated by foreign sanctions, serving as a decentralized asset that holds value regardless of central bank policy in Washington or London. To manage this security, India stores its gold both domestically and across multiple international locations to spread the risk. The Bank of England serves as one of the primary international custodians for India's gold reserves.
A portion is also stored with the Bank for International Settlements, which acts as a secure vault for sovereign gold. The final slivers are special drawing rights and the reserve tranche position, emergency lines of credit maintained with the IMF. Beyond immediate rupee defense, the RBI is restructuring its vault to ensure these assets remain liquid and untouchable in an increasingly fractured geopolitical landscape. This context allows us to reevaluate the historical crisis of 1991. In 1991, India had only 1 to 2 weeks of import cover remaining. Today, despite the $11 billion drop, the country still has enough reserves to fund 10 to 12 months of vital imports without earning another dollar. This 10-month buffer represents a massive zone of safety compared to the precarious position the country faced 30 years ago. This buffer directly supports India's sovereign creditworthiness, signaling to rating agencies that the nation is not a default risk. A high credit rating keeps interest rates lower for the government when it borrows to fund national infrastructure. While the system is robust, continuous depletion without replenishment would eventually trigger inflation and erode investor confidence. The primary replenishment for this buffer comes from inward remittances, which now total over $100 billion annually. This critical hard currency inflow is driven by Indian citizens working abroad, specifically those in the Middle East who send their earnings back home. This $11 billion contraction proves the macroeconomic fortress is functioning as designed, absorbing external volatility to preserve domestic growth.